Okay, so today we're going to look at journalizing adjusting entries. So you should watch the PowerPoint lecture prior to doing this because it explains some of the concepts of adjusting entries. So we look at Carl's construction and we look at the trial balance as of December 31st, 2018. Now remember, this trial balance is also the unadjusted trial balance. We don't need to put unadjusted. That's a given. So the trial balance here is showing the result of all of the transactions of Carl's construction for the year. Okay, so all the journal entries, all the posting, everything has been done. So this is the trial balance as of the end of the year. Now, it turns out that Carl's Construction needs to do some adjusting entries to update their revenue and expense accounts. Remember that that is the most important part of adjusting entries. They also update asset and liability accounts as well. So here are the adjusting entries. So it says Carl Raymond, his accountant, recognized the following adjustments for year end. So the first adjustment they look at is depreciation, and that's on the building equipment. So that, of course, right, is a plant asset. So that's an asset that's going to last longer than a year. It's a fixed or a plant asset, and it needs to be depreciated. So in the chapter, we learned about straight line depreciation. That's the easiest way to do it. And we can see that the useful life is 10 years and the salvage value is 4,000. So we're depreciating for the entire year. We're assuming that the 40,000 is the cost. So if we were to do out the depreciation, we would have the cost is 40,000. The estimated salvage value is 4,000. Or depreciable cost is 36,000. Okay. Now what we're going to do is we're going to divide that by the estimated useful life. Of 10 years. And we will get our annual depreciation expense. So we will take the 36,000, that's our depreciable cost, and divide it by our estimated useful life of 10 years, and we will get $3,600 per year. So our entry for 2018, okay, in our adjusting entries, will be a debit to depreciation expense. Right now, these accounts are not listed on the trial balance as of yet. They will be listed on the adjusted trial balance, but they would have to be in the ledger and the chart of accounts for us to be using. So we're going to have 3,600, and remember that each plant asset has to have an accumulated depreciation account. So we're just going to abbreviate that, and this is the building equipment. And that's going to be a credit. So it's going to be indented. So we're doing adjusting entries. Okay, we're going to do all of them as of the end of the year. Okay. We're still going to follow the same rules of journalizing. We're going to put our debits first. We're going to indent our credits approximately a half an inch. Anytime we do adjusting entries, we do them on a separate journal page, and we put adjusting entries up at the top of the page. So who's ever looking at it knows that these are not transactions, these are adjustments. Okay? Remember, adjustments update the expense and revenue accounts and also the liability and asset accounts. So we must do them, because if we don't, then our financial statements will be inaccurate. It's important we do this, okay? So the second adjustment is the supplies inventory shows $50 in supplies on hand. Supplies on hand means that's what we have. Okay, so that's what we have in our supply cabinet. Our supplies account started with 180 at the beginning of the year. So somebody counted it and found that there's 50 left. So we must have used 130. Okay. So what we're going to do is we're going to put in our date. We're going to debit supplies expense of $130. And we're going to credit supplies. So if we did not do this adjusting entry, that expense would have been forgotten, and we would have overstated our net income. Same with the depreciation. So these adjusting entries arise out of things that we don't necessarily record on a day-to-day or a week-to-week basis, okay? But they're expenses and revenues that we have to recognize. So our third one is rent expired at $80. So this is related to the prepaid rent account. So this would be related to the prepaid rent account. Prepaid rent, remember, is an asset, okay, because it's providing a future benefit. But as time goes by, we use it up. And when we use it up, it no longer provides a future benefit, it becomes an expense. So in this case, we've used up $80. So again, we're going to skip a line just like we did in Chapter 2. We're going to debit and expense 80, and we're going to credit prepaid rent. Okay, prepaid rent is an asset that is decreasing. It needs to be credited. Rent expense is an expense that's increasing. It needs to be debited. Next one, D, salaries earned but not paid. This is a very common adjusting entry because oftentimes paydays, do not occur at December 31st. So companies are required to accrue the salary that they owe to their employees. Because remember, we have to recognize the expense. We're using the accrual basis of accounting, right? We have to recognize expenses when they are incurred and revenue when we earn it, regardless of when the cash is exchanged. Okay, so we're going to have a debt to salaries expense because that's increasing, right? And that's $650. Now, if we didn't pay our employees and we're recognizing this expense that we've incurred, we have a liability. But it's not going to be accounts payable. Accounts payable is dealing with our vendors and our suppliers. So salaries, has a lot of complex moving parts. So we need to have a separate liability account for salaries. So what we're going to do here is credit salaries payable. And that's going to be for $650. Now, our last adjusting entry is accrued revenue, $800. Well, to accrue something means to add to it, to build it up. It's like accruing vacation time at work. So what we find here is that we have $800 of revenue that for whatever reason was never recorded. Okay, now, if we had received the cash for it, it would have been a transaction. So we know that we did not get paid. So this means that customers owe us $800. For whatever reason, it did not get recorded, so we need to record it. We need to recognize that revenue, okay? And we also need to recognize that we have accounts receivable. Because if we don't recognize those things, if we don't record those things, they won't end up on our financial statements, and we will not be providing a clear picture to the readers of our financial statements. So if we don't do this adjusting entry, we will be understating our revenue. So we're going to debit accounts receivable for 800, and we're going to credit service revenue for 800. We don't need the zeros there. Okay. So these are our adjusting entries for Carl's Construction. Okay, and you can see that these are going to have an impact on the financial statements. So our next step in the next video will be to post these adjusting entries, and then we will create the adjusted trial balance. Thank you for your attention.